So picture this. You were one of the first adopters of Bitcoin. You bought it at 3 cents. A couple months later, it's worth $30, and then back down to $2, and then up to $100, and then down to $20, and then screams higher to $1,000, and then crashes down to $150. People love talking about and dream about owning assets from their early inception. Bitcoin's the greatest example here. Holding on and making a 10,000x return, 20 years later, turning $5,000 into millions, if not billions of dollars. But the reality is that most people would have never held on that long. The volatility, the FUD, the news, the social media hype. Bitcoin had 80% drawdowns since 2011. But has returned over 200,000% since then. All of this would have probably gotten you to sell your bag way before it got to that humongous figure. And that's what separates you from centimillionaires and billionaire investors of the modern world. Remember, in investing, your job isn't to avoid the ride. It's to stay strapped in when the track disappears. This is the psychology of high-risk investing and how to stay disciplined all the way up. Hey everyone, welcome back to the channel. If you're new here, I'm Patrick. I've been an investor for over a decade, an options trader and a crypto investor for 7 years. I've grown my portfolio at over $250,000, and I run Apex Wealth Collective, a school community for investors where you can follow my portfolio journey, see all of my buys and sells as soon as I make them, and get deeper market analysis. Also get access to all of my YouTube content early and get your questions included in any future Q&A videos. Link is in the description below. Now, to preface this video, we are talking about investing in quality assets that have shown a lot of promise. We are not investing in penny stocks or meme coins. We are finding assets like a Tesla or a Palantir or Coinbase or Robinhood, quality assets, not lottery tickets. Now that we have that out of the way, first things first, before we armor up with the rules, we gotta name the enemies. Remember, high risk investing means you are investing in assets that will probably have very high volatility in the beginning. This means that you will see the 1000% gains in bull markets, but on the flip side, hold long enough and you will see the 80% drawdowns from all-time highs. This is normal. You can't have the massive outsized gains without the drawdowns that flush out leverage, speculation, and the tourists who bought the hype trying to make a quick buck. So let's move on. Trap number 1, loss aversion. The 2-to-1 pain ratio. In an experiment, Nobel Prize winning researchers Kahneman and Tversky proved losing $1,000 hurts twice as much as gaining $1,000 feels good. It's not opinion, it's fMRI brain scans. When your altcoin or stock drops 50%, your brain screams, oh my God, stop the pain. Even if the thesis is fully intact, even if nothing has fundamentally changed from the company other than the price, your lizard brain screams. When you lose $1,000, your brain doesn't see I'm down $1,000. It says I'm down 2 PlayStations or a tablet or rent or a car payment. You don't see, oh, losing $1,000 is my education for volatility. It sees, oh, I could have paid off my orthodontist bill. The fix here isn't just, oh, be tougher. It's design the game so the pain never hits your decision centers. We'll do that in the rules section after. Now, trap number 2, narrative hijacking. Social media can be a blessing and it can be a curse. It just depends on how you use it and who you choose to follow. X can turn a 10% dip into Project Rugged and stock is dead, sell, sell, sell. Your lizard brain believes the loudest story or the loudest post, not the data. It trusts narrative coherence over raw data. Behavioral finance calls this the availability heuristic. The loudest, most emotional story wins. So remember to have a bulletproof thesis that you can fall back on when the heat gets close. Trap number 3, the dopamine slot machine. This one's the most dangerous. Investing has been gamified. Look at platforms like Robinhood or Wealthsimple for my fellow Canadians. Colorful UIs, eye-catching functions and sounds and notifications, buttons that make you feel good when you press them and they're responsive, all done to reel you in, to make you overtrade, to make you stay and use their platforms more often and trade hype stocks from the main page. Every green candle is a hit of dopamine. You start position sizing with emotion, not math. High volatility charts are digital slot machines. Every 1 hour candle is a lever pull. The result? You're all in at the top and margin called on the dip. Get in, buy or sell your position, and get out. Stop lingering around on these platforms and watching charts tick by tick. Investing is a long-term game measured by years and decades, not minutes and hours and earnings reports and Twitter sentiment. These exchanges and platforms don't care about your P&L. They care about giving you your next dopamine hit, and they will bankrupt you if you give in. You can have a lottery or degenerate bag that's like 5% of your portfolio to just have fun. Just keep it small. Remember to keep it small. Now that we have talked about the enemies of staying disciplined and remaining on track to your goals, let's talk about the rules to stay disciplined and keep you going to the finish line. I'll give you 5 battle-tested rules to make these traps irrelevant, even when the chart looks like a slasher film. Now, rule number 1, pre-commit capital and time. Before you click buy, decide, how much of my net worth am I willing to put down on this investment, and how long am I willing to be wrong? For me, personally, it's minimum 1 market cycle, which is 4 to 5 years in crypto and tech stocks. Write it on a Post-it. Stick it on your monitor, stick it on your forehead. When the negative 70% hits and nothing has fundamentally changed with the company, you don't negotiate with terrorists, you point at the Post-it note. Rule number 2, use if-then automations. Create automatic triggers that you can only act on when they get triggered. Example, if price drops, 50% from your average buy-in price, then move 50% of your position to stablecoins or cash and reassess your thesis in 30 days. Or if you really believe in the thesis still, make it an area to add to your position. No emotion, just mental code. Set price alerts, calendar reminders, whatever you need to do. Your phone can become your therapist. Now, rule number 3, build a thesis. Every position gets a 1-page Google Doc. Why I'm in it, key price milestones to introduce trailing in-profit stop losses, invalidation triggers, and key areas to add to my position. So when price moons, you can reread it. It stops you from marrying the gains. And when price crashes, reread it again. Stops you from divorcing the idea. I've got 15 dead theses in my graveyard, each one being a tuition payment or more. You're gonna mess up, but following the rules will keep you coming back to see another day, and there will be gold nuggets in this pile that will make up for all the losses and more. Now, rule number 4, schedule dopamine elsewhere. High volatility investing, like I talked about in the traps, is a slot machine on your lizard brain. Counter it with scheduled wins. Monday, Wednesday, Friday gym sessions, monthly dinner with friends, learning a new skill outside of investing, getting involved in a recreational sport, watching movies, playing video games. When your brain gets hits of dopamine outside the charts, it stops hunting them from inside. And rule number 5, use the stranger test. Before any trade, explain it out loud as if a stranger is on a plane with you. If you can't finish the quick 1 to 2 minute explanation without jargon or hype or complex thoughts, don't click buy. Clarity beats conviction. Invest in what you understand. Follow all of these rules and avoid the traps we talked about earlier, and you will be well on your way to crafting a specific framework that works for you. You need to build a framework that is unique to you, because factors that affect one person may not affect the other. So know your lizard brain and where your pitfalls are, and create rules to keep that lizard brain off limits. If you're in your 20s, you have nothing but time. If you're in your 30s, you got a lot of energy. If you're in your 40s, you have a lot of wisdom. All of you have the same shot if you master the mind games of high risk investing and staying disciplined. So make sure you know the traps to avoid to stay in the game and fight another day, and the rules to follow to not blow your portfolio up, creating setbacks and having these events bleed into other parts of your life. Train your mind to be a bomb shelter, and you are well on your way to creating generational wealth over the next 10, 20, 30 years. Commit hard to your goals, because you only have this one life to make it right. Now, if you've stuck around this long, go ahead and catch another one of my videos right over here, or check out my channel over here, where you can take a look at all the other investing content I have to offer about investing in my personal investing journey. Now, that's all for me today. I'm Patrick with Apex Wealth Collective. Take care, and I'll see you guys in the next video.